Hey everyone, and welcome back to the channel where we demystify the complex world of finance, one stock at a time. Today, we're diving deep into a specific situation that's been lighting up our hard-to-borrow screen, the microcap stock, DXST. We're going to break down why DXST is appearing on our radar, what its current statistics mean, and what you, as a potential investor or simply an interested observer, should be watching for. But first, a critical word, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk about DXST. This is a micro-cap company, meaning it has a relatively small market capitalization. When we look at its recent price action, it tells an interesting story of a lack of action, at least on the surface. Today's change for DXST is plus 0.0%. Over the last 5 days, it's also plus 0.0%. And looking back a full 30 days, we see the same picture, plus 0.0%. The volume figures echo this stillness, with today's volume at 0 shares and the 30-day average volume also at 0 shares. This means its relative volume is 0x average. So, on the face of it, DXST appears quiet. But beneath this calm surface, our hard-to-borrow data reveals some intense pressure building up. What is cost to borrow and why it matters? Before we get into DXST's specific numbers, let's quickly explain what cost to borrow is and why it's so important in the world of short selling. When you want to short a stock, you're essentially borrowing shares from a broker, selling them, and hoping to buy them back later at a lower price to profit from the difference. But borrowing shares isn't free. You pay a fee, known as the cost to borrow, or CTB. This fee is usually expressed as an annualized percentage. Think of it like interest on a loan. The higher the short interest, the scarcer the available shares, and the greater the demand to borrow, the higher this fee can go. It can even exceed 100% annually, meaning short sellers are paying over 1% of the stock's value every few days just to maintain their position. A rapidly increasing CTB is a strong signal that short sellers are feeling the heat, as it directly eats into their potential profits. Why the stock is hard to borrow right now. Now let's apply that to DXST. This is precisely why DXST landed on our hard-to-borrow screener. The annualized cost to borrow fee for DXST right now is an astounding 686.1%. Show CTB chart, that's not a typo. To put that in perspective, a fee this high means short sellers are paying a massive premium just to hold their short positions. What's even more compelling is the CTB momentum. It's surged by plus 163 percentage points over the last approximately 5 trading days. This indicates a rapid tightening of borrowable shares and increasing demand from short sellers who still want to short, or a decreasing supply for those who are already short. Currently, there are only about 15,000 shares available to borrow. When you compare that to DXST's estimated float of 1.2 million shares, you can see how tight the supply of borrowable shares is becoming relative to the total number of shares that can be publicly traded. Our internal composite squeeze score, which combines CTB level, CTB momentum, shrinking borrow supply, float size, volume/price momentum, and technical setup, puts DXST at 54.8 out of 100. This is a respectable score, especially considering the lack of recent price and volume action. Squeeze mechanics explained. So, how does this high cost to borrow and shrinking supply lead to a short squeeze? It's a chain reaction. When a stock becomes hard to borrow, and the fees like DXST 686.1% skyrocket, the cost of being short becomes unsustainable for many short sellers. If the stock then starts to tick up, even slightly, it creates a powerful incentive for these short sellers to close their positions to stop the bleeding from both rising price and rising fees. How do they close a short position? They have to buy back the shares they initially sold. This buying pressure, even if from just a few short sellers, can push the stock price higher. This higher price then triggers more short sellers to cover, creating a cascade of buying that squeezes the shorts out of their positions, potentially sending the stock much higher in a short period. This is the essence of a short squeeze. Dilution risk check. One crucial factor to consider when evaluating a potential short squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding. This can often negate or significantly dampen a short squeeze thesis for 2 main reasons. First, new shares can provide an easy source for short sellers to cover their positions, alleviating the pressure of a tight borrower supply. Second, by increasing the total share count, it reduces the ownership percentage of existing shareholders and can depress the per share value, making any price gains from a squeeze less impactful. For DXST, our diligence revealed no recent dilutive SEC filings like SMINUS1, SMINUS3, or 424B in the last 90 days. Furthermore, we found no recent reverse split for DXST in our look-back window. This is a positive sign for the squeeze thesis, as it suggests the existing share structure is intact and not immediately subject to new share issuance that could undermine a squeeze. As we move into what to watch for, let's quickly reiterate our disclaimer. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given DXST's incredibly high cost to borrow of 686.1% and the mere 15,000 shares available to borrow against a 1.2 million share float, this is definitely a stock to keep on your watch list. Despite the 0% price change and zero volume we've seen recently, these hard-to-borrow metrics suggest a highly strained short position. What could trigger movement? Any increase in trading volume, even a small one, could act as a catalyst. If legitimate buying interest emerges, the scarcity of shares could quickly drive the price up, putting immense pressure on those short sellers paying the eye-watering 686.1% CTB. It's important to be balanced here. A high cost to borrow does not guarantee a squeeze. It can also mean short sellers have extremely strong conviction in the bearish thesis and are willing to pay almost anything to maintain their short position, believing the stock will eventually fall significantly. However, when those views compound, that conviction is tested daily. Watch for any signs of increased institutional or retail interest, and specifically, any uptick in volume or price action. In summary, DXST is a micro-cap stock that, despite its current lack of trading activity, exhibits extremely high hard-to-borrow metrics with an annualized cost to borrow of 686.1% and a very limited supply of 15,000 shares available to borrow. The absence of recent dilution risk is a positive factor. While these conditions create the theoretical setup for a short squeeze, it's critical to remember that high CTB alone doesn't guarantee a squeeze. We'll be keeping a close eye on DXST for any developments. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth analyses, and let us know in the comments what other stocks you'd like us to cover next. Thanks for watching, and happy trading!